is Sean Wolin, and this is your March 28th of 2022. And I'm going to start it off with just a little bit of a joke this morning. So, joke for the day: what did the police find on Chris Rock's face after Will Smith hit him at the Oscars last night? Fresh Prince. Yes, I know, super cheesy, but hey, got to start it out with a joke, especially in light of interest rates. And let's jump into that right now. Rest in peace. Low interest rates from 2020 to 2022. They are a thing of the past, unfortunately. We have to live with the new norm, and we'll jump right into that right now. So if you look, let's put this over here for now. Let's look to see kind of where we're at. 30-year fixed, we're at 4.95 with points as the national average right now. Yikes, guys, we are in the fives with no points. Didn't think we'd get here this fast. I thought it'd be closer to the summer based on the inflation numbers. But remember when I said inflation is going to peak in the month of March, and here we are. And now we have rates at their highest point since 2018. And so what's next? Let's look at the charts. All right, so this is the Fannie Mae Bond this morning, and we're looking at the 4-year 4% coupon now. As you can see on this candlestick chart, it's been a run lower on these mortgage-backed securities for a good portion of the year. We've had a few days upward that we bounced a little bit, but for the most part, it's just been a downward cliff. Friday was a bad day. We are now bouncing off this Fibonacci level right here. If we can hold here, we may be able to gain some ground bouncing off of this up towards here. But it is a big week this week, and we'll go over kind of what the calendar is. Fed spoke. Remember, the Fed spoke back here. We actually had a couple days, and then just the inflation is just too much. Had a little bit of a rebound. We tried to here, and then it just keeps coming down. So let's kind of have a look at what the Feds are going to be doing moving forward. Remember, the Fed funds rate is the rate at which banks borrow money over the 24-hour period from each other for the Fed window. But here's what the Feds are expecting, what Bank of America is expecting, and what Citi is expecting as far as the Feds move upward on the Fed funds rate. So in May, the Feds are expecting 25 basis points. Bank of America also is expecting 25. Citi is expecting that they'll raise it by 50 basis points. So Citi thinks that we're going to have a 250 basis point swing in the Fed funds rate over the year, whereas the Feds are expecting about 150. So anywhere between 150 to 250 basis points higher in the Fed funds rate is what we're expecting. This does impact mortgage rates on home equity lines of credit. Because home equity lines of credit are based on the prime rate, which is typically 3% over the Fed funds rate, we could see rates right around, well, they could be up to 4.5%, 6%, 7%. Depending on which of these factors are going to be portrayed out or what the future holds for the Fed's moves this year. But either way, you can see we're in for a lot of rate hikes. When the Fed moves the money and makes it more expensive, less money is injected into the markets. Less people borrow because it's more expensive. That slows down the economy. And the big fear is, will this create or push us into a recession? Remember, when there's slowing down of the money in the marketplace, it slows down businesses. They don't borrow as much, and that could slow down the markets, which is the whole point of doing this. We want to slow down the markets because inflation is hot. The only way to do that is to raise rates. But that could push us into a recessionary period, which means rates may come down if that recession does come. So let's look to see what's next on that. Now, adjustable rate mortgages will probably become more popular. And you may be wondering, well, adjustable rate mortgages, aren't those the instrument that really fueled a little bit of the crisis that we had? And yes and no. If you use adjustable rate mortgages properly, they can be a good tool in a raising interest rate environment. When we know that maybe 3 to 5 years, there may be opportunity to refinance. So who may be a good candidate? Those that may be paying off their homes within a 5-year period. So if you got customers in California moving over here, selling their home later, an adjustable rate mortgage may be good for them to get a lower introductory rate that's fixed. I would say do a 5-year fixed. Remember, the rate won't change for 5 years, but a refinance opportunity is highly likely in the next few years. So you could use this as a temporary way of getting a lower rate for the next couple years, because I believe in my heart that we will see lower rates in a year and a half to 2 years out, depending on how quickly we can get this inflation under control by these Fed moves higher on the Fed funds rate, because recessions typically bring lower mortgage rates. So adjustable rate mortgages may come back. So I really liked this, and this is a quote by Dr. Seuss. Don't cry because it's over, smile because it happened. So we had this massive dip in interest rates. Don't be mad that it's over. Be happy that it happened, because the last 2 years was crazy. It was crazy good for everyone in the mortgage industry, crazy good for everyone in real estate. Yes, it's a pretty big spike upward, but let's be thankful that we had those low rates, and not be bitter and angry that they're gone. So I would share this because I think it's a pretty powerful statement. So this week's calendar, what's going to happen? Today we have the Treasury auctions that are happening, and the Treasury auctions on the 2 and the 5 year note. Tuesday we got the Case-Shiller home price, that'll show the appreciation of what the markets are doing. This is expected to be really high. Wednesday, ADP numbers, the jobs reports are coming out, and GDP numbers on Wednesday as well. Thursday, we have the PCE. This is the inflation report. This is going to be really interesting to watch. This could be really market moving. And then Friday, we have the unemployment rate, BLS jobs report, expecting between 400,000 and 450,000 new job creations. So it's going to be a big week. Lots is happening that could be rate sensitive, that we could see big swings either direction in the markets. So I will keep you updated as we move forward. Have a wonderful week, everyone. And again, thank you for everything that you do for supporting my team at the Woolon Mortgage team here at Cherry Creek Mortgage. If you do need anything, I will be available all week for you. Have a great week, guys. Talk to you soon.